Hey everyone, it's Zach Otten with Peak Elevation Homes and Home Smarts. Hey, just wanted to reach out, made a quick video here today on and explain a little bit about how interest rates could actually technically decrease or increase technically as well, but how they're more likely to decrease this year, even if the Fed were to not lower their interest rates, which they said they're going to, or they're planning to, 2 to 3 times this year. But as we know, you never know what the Fed will do. But anyway, so just wanted to, I guess, explain this a little bit. So the interest rates historically have roughly been about 175 basis points or 1.75% interest rate spread between the 10-year Treasury, uh, the bond, and the interest rates on a 30-year fixed mortgage. So, for example, if the 10-year Treasury was sitting at about 3%, interest rates historically have been about 4.75% because of that 175 point basis spread. Right now, we're currently sitting at roughly about 278 basis points difference. So that's essentially a whole extra percent on top of the mortgage on a 30-year fixed. So if, let's say, the 10-year Treasury is at 3%, we've been at about 5.75 instead of 4.75 for interest rates. So long story short is essentially if that were to normalize, if the basis point spread or the spread between the 10-year Treasury and interest rates were to decrease to this normal 175 basis points, that was how interest rates could actually decrease without the Fed actually making any adjustments on their interest rates. Um, that's probably very confusing, but a quick synopsis on kind of how that works and why we're likely to see rates drop this year, even if the Fed does not drop their Fed fund rate. So hopefully that helps. Thanks.